Wall Street taking another leg down in what has been a seesaw week because of the coronavirus. Well, let's talk about what's going on with the markets today. I'm joined by Peter Cardillo. He's the chief market economist at Spartan Capital. Thank you for joining me, Peter.
Thank you for having me.
So we got the coronavirus back in the market. We got the CDC saying there's the first person-to-person transmission here in the U.S. We got a Carnival cruise ship that won't let people off in Italy. We got companies telling their workers to stay home. What is the impact of this on investor psychology?
Well, obviously it's negative, but I think it's more of a fear factor than any real shift in terms of impacting economic activity, at least here in the States. Now, of course, if we look at what's happening in China, that's a little bit different because many businesses have been shut down and even some of the holiday has been extended. And so that will have some sort of an impact on the Chinese economy, and that obviously is the fear factor that the global economy may be affected by this. In fact, I don't know if you have noticed, but part of the yield curve is inverted. That is, the 3-month bill has surpassed the 10-year yield. And so, that just shows us that there are worries that there will be an economic impact. However, I kind of think it's a little too early to come to that conclusion, and I suspect that this is more of a fear factor than any shift in market sentiment.
But Peter, there is a reason to be afraid, yes, because if we take a look at the SARS epidemic that happened a couple of years ago, China's role in the global economy is now much bigger than it was then, correct?
Correct, but also let's not forget that 4 or 5 years ago, the Chinese economy was growing north of 7%, and now just the opposite. We're down to 6%. And so we've had a major slowdown due to the trade war. The question is, how much will this shave off of China's GDP? I think for the moment it's too early to tell. But if things got really rough, we could see maybe a half of a percentage point being shaved off, and we could see maybe 5.25–5.5% growth.
So we know that the market makes moves now and asks questions later. So if there is this real fear in the market, tell me, where can we hide? I was looking at some of the sectors, and it seems like, the sector, if they're not exposed to China by the way of a supply chain, they are exposed to China by the way of consumers. So where in the universe of stock picking could you hide right now?
Well, I don't think you can hide anywhere, to be honest with you. I think the only place you can hide is in short-term paper, like in treasury bills, and of course gold. Those are the two hiding places at the moment.
All right, let's focus a little bit more on the U.S. Earnings season is going on. We had about 200 of the 500 companies in the S&P 500 are reporting results so far. Profits, the estimate for this quarter now up to 0.7%. Revenue estimate up to now 4.5%. Is that good enough to support a stock market that, despite today's decline, still pretty close to record highs?
Absolutely. I think, as I said before, what we're seeing here is a fear factor, and that fear factor is causing some profit taking and cautiousness in the market. But I remain cautiously optimistic that the sentiment is not going to change, at least for now. And by early next week, by mid next week, I should say, we can probably have confirmation that the earnings season is going to get a fairly good grade. And so that means that valuations are still not a problem. What may be a problem is weaker economic indicators going forward. Now, we had a glimpse of the Q4 GDP, which came in at 2.1%, basically in line with forecasters. But the big question is, will consumer spending continue to slow down? And obviously it's slowed down from Q2 and Q3. And so that's the big question. And certainly the fact that capital investments is still missing in the equation of economic growth it could be a concern. So I think over the next 6 to 8 weeks, the macro indicators are probably going to be the real driving force of the market. I think, as I said before, by mid next week we will probably have a grading score for the earnings season, and it should be okay.
So what do you tell investors to do here? If there's concern about the coronavirus and it's still too early to tell, we got the GDP figures today showing that consumer spending is slowing down, business spending still hasn't picked up. So what should investors do? Sit on their hands right now? Until when? Until what signal?
I would say they should stay the course until we get more evidence that maybe the economy is weakening, maybe our call of economic growth around 2.3% for the whole of 2020 is not going to be obtainable. Until we have evidence of that, I would stay the course.
All right, great. Thank you so much. That is Peter Cardillo. He's the Chief Market Economist at Spartan Capital. I'm Conway G. Gittens, and this is Reuters.